Hello Wolfpack, let's talk about interest rates and why the next 48 hours is going to be very, very important for the future of not only traditional markets, but also the cryptocurrency market. First and foremost, what is an interest rate? An interest rate is the amount a lender charges to the borrower and is a percentage of principal, the amount loaned. The interest rate of a loan is typically noted on an annual basis known as the APR. So essentially speaking, an interest rate, for example, on a mortgage, for example, is how much you pay back. Now, the Federal Reserve in the United States and essentially the government who acts in line with the Federal Reserve determine what kind of a base level interest rate will be, and then banks can work from that and have a little bit of leeway to offer better prices, offer better interest rates from that. Now, interest rates have to shift with the economy. For example, if you're in a period of high inflation, it's very logical to raise interest rates to counteract that inflation and try fight inflation, where if you're in a period of very low inflation, you want to actually be lowering interest rates to encourage more spending and encourage more loans being taken. Because at the end of the day, the government doesn't just, or the Federal Reserve doesn't just print money. That's not really how it works. The money is actually created through loans and through debt. Now, interest rates are at historical lows here for the Federal Reserve. They're basically at 0.25. And essentially, these were dropped down massively by Donald Trump and by the Federal Reserve at that point in time during the start of the COVID-19 pandemic. This was in order to keep flexibility in the budget of the United States. They could spend more money during the pandemic and kind of try and fight COVID-19. Now, it's debated as to whether that was the best option to take, but that's the option they took. And essentially, when the government thinks they're going to be spending more money, they want to keep interest rates low, because the biggest borrower of cash in the world really is the government of any country. And for example, in the United States, the biggest borrower of the US dollar is actually the US government. And so if they have high interest rates, they're dooming themselves to higher payments. So if they want to spend a lot of money, this is why in war times, for example, you see interest rates drop. If they want to spend a lot of money, they're going to actually have low interest rates, and that's what we saw during COVID-19. Now, unfortunately, these low interest rates and the massive amount of spending during this time have pumped inflation up very, very high. In fact, to the highest level we've seen in 40 years. And what's more interesting about this is that the way we calculate inflation isn't the same as it was 40 years ago. They kind of try and make the number look as good as possible as not to scare the population. Because at the end of the day, if you're the government and you have very high inflation under your rule, you're not going to get voted back into power because people will be, negatively affected by your rule essentially. And so they've changed the way they've calculated inflation. I would argue it's the highest level of inflation we've seen since the 1940s, but that's up for debate. So how do interest rates affect the stock market, and how does the stock market affect the cryptocurrency market, and how do both affect both? So essentially what I'm asking is, well, how do interest rates affect crypto? Well, one of the ways would be, it could send us into a recession if they're not managed correctly, if they're not raised correctly, or if it's gone too far and we're acting too late, could very easily send us into a recession, in which case, and I'll explain this more in a second, but in which case cryptocurrency has never been through a recession and we don't know how it will react. Yes, on paper, crypto should be kind of like a bit of a safe haven for that kind of thing. But crypto is not a lot of things it aims to be. I mean, it's debatable as to whether it's a hedge against inflation. I was having a very interesting conversation with Mega Well Crypto this morning. It is technically a hedge against inflation by definition. But as for a store of value, that's a different question. And it's all circumstantial. It really depends on the circumstances. But essentially what I'm trying to say is that Bitcoin specifically is not right now what it aims to be one day. And so to act like it's going to act in accordance with what it aims to be one day, in which case it would not act with traditional markets in a recession, is illogical. We have to kind of go in blind here. We don't really know what's going to happen. If the financial markets go into recession, what will crypto do? We don't know. So how do interest rates affect the stock market? When the Federal Reserve acts to increase the interest rates, it immediately alleviates short-term borrowing costs for financial institutions. This has a ripple effect on virtually all other borrowing costs for companies and consumers in an economy. Because it now costs financial institutions and companies more to borrow money because they have to pay back more debt now that the interest rates are higher, these same financial institutions often increase rates they charge for their customers to borrow money. So individual customers are impacted through increases to their credit card and mortgage interest rates, especially if these loans carry a variable interest rate. When interest rates for credit cards and mortgages increases, the amount of money that consumers can spend decreases. So essentially, when you raise interest rates, the general public, they're not going to make any more money, but they're going to be spending a lot more money on their mortgages, on their cars, on whatever they've taken a loan out in the past, and that is not something that they can change, right? So if you take a mortgage out at a set rate, say for example, you take a mortgage out at say 3% per year, if interest rates rise as the Federal Reserve raises interest rates, that's still going to go up. It's not locked in at 3% unless you've got some sort of special contract. Consumers still have to pay their bills. When those bills become more expensive, households are left with less disposable income. And when consumers have less disposable income, businesses' revenues and profits decrease, and so naturally the stock valuations are either going to stop growing, or they're going to go down, or they're going to grow at a much slower rate. And so when you're in a period of high inflation, of historical low interest rates like we're in now, the stock market, the S&P 500, for example, has grown at a rate in which we've never seen before. It's grown very, very, very quickly. And so there needs to be a period of pricing in these rates drops, because there's going to be a big shock to the market when that comes in. Now, the goal of the Federal Reserve is to do this gradually, so it doesn't actually kind of boom, affect it all at once. But as to whether this will work or not is very debatable. I mean, they've delayed this for years now. So as you can see, as rates rise, businesses are not only impacted by higher borrowing costs, but they are also exposed to adverse effects of flagging consumer demand. Both of these factors can weigh in on earnings and stock prices. Now, the extremely interesting thing I want to look into before we get into recessions is what interest rate rising does to the DXY. This is the DXY, essentially a chart that measures the strength of the US dollar in relation to other global currencies. Now, as you can see, this chart is extremely reverse correlated to Bitcoin, okay? In January 2018, this thing bottomed out while Bitcoin topped out. During the entire 2017 bull run, this thing was dumping. When Bitcoin topped out, when the crypto market started crashing, this thing started pumping. And when the halving happened in 2020 and Bitcoin started going up again, this thing dumped. And now recently, when Bitcoin has been crashing, this thing has been going up. The reverse correlation is undeniable. When this thing goes up, Bitcoin goes down. Now, unfortunately for Bitcoin, when there are times of panic, such as what can be caused by an interest rate hike, people generally sell all of their risk on investments, all of their risky assets in general, everything they have, and flock towards the US dollar, because the US dollar is seen, widely still seen, as a viable store of value. So when we see these interest rate hikes start to take place this year, what we can expect to see is the DXY keep climbing, keep taking resistance, and that will have a negative effect on the cryptocurrency market, just like what it did in 2018 through to 2020. Now, speaking of recession, one of the reasons people are so concerned about us going into recession is because this part of the paragraph here sounds exactly like what's happened in 2021, sorry. Artificially suppressed interest rates during the boom times leading up to a recession can distort the structure of relationships amongst businesses and consumers. Now, what we saw in 2020 was massively artificial kind of booms in the market, booms in certain sectors, booms in businesses that has done just that. It happens by making business projects, investments, and consumptions between decisions that are interest rate sensitive, such as decisions to buy a bigger house or launch a risky long-term investment business expansion, appear much more appealing than they ought to be. Now, you would have noticed during 2020 and 2021, many mortgage companies, many banks offering services for extremely low interest rates and advertising that widely. You would have noticed the FOMO from the media being spread about how you need to get into the housing market now, about how it's going to keep going up. This is the same thing we've seen time and time again. It's the same thing we're seeing in this paragraph right here. The failure of these decisions when rates rise to reflect reality constitutes a major component of the rash of businesses' failures that make up a recession. Now, when this all goes wrong and when these rates do rise and no one can pay back the money they've taken out, that ultimately causes a financial recession, as no one has any spending power to fund these businesses, to fund the products being sold, and you enter a financial recession because the stock valuations plummet, and people realize that the market was extremely overvalued, and that just because the market cap was something, it didn't actually mean the value of that business, the value of that stock, the value of that company was the same. So in 48 hours here, or depending on whenever you're watching this video, in fact, it's pretty time proof, we are seeing a big decision from the Federal Reserve. Do they keep interest rates the same? Do they raise interest rates by a quarter point? Do they 25 basis points? Do they raise interest rates by 50 basis points? What do they do? What we can say for certain is that if they don't raise them now, they're going to have to raise them later in the year. And depending on how much they raise them, it could affect the market more or less. But what I can say is that we're entering a period in which they will be raising interest rates gradually, even if it's not this month, which I think it will be. They're going to raise those interest rates gradually, and it's going to be strain on the financial markets that is going to be unavoidable. And that will no doubt, according to all historical trends we have, negatively affect Bitcoin. Now, obviously, if we enter a recession, which isn't a guarantee, but it might happen, we are going to be entering a period of uncertainty, and the best thing to do in uncertainty is to stay clear of the market and wait until there is certainty. Thanks for watching, guys. Hope you enjoyed. I hope this cleared a few things up, and I'll catch you in the next video.